This video will go through the key concepts of Unit 3.2, Sources of Finance. This topic will look at the various ways in which a business can obtain the finance it requires to run their operations. This is one of the more important qualitative topics in this unit, and the content here can be applied in a number of different case scenarios, and will also link to a lot of the things we'll discuss later on in Unit 3. Internal sources of finance are the funds that come from within a business itself, or in other words, when the firm uses its own resources to fund its operations. There are three internal sources of finance that you need to know. The first is personal funds, which refer to the money that an entrepreneur or a business founder invests into their business from their own savings or their own personal assets. So this form of financing is very commonly used when starting a new venture or when the founders need to support existing operations and keep the business afloat. This can be a beneficial source of finance, but it also relies on the founders having sufficient finance of their own or sufficient assets of their own to invest in the business. The next is retained profit, which is what is left over after all costs, interest, tax, and dividends are subtracted from revenue. Now, if you aren't familiar with all these terms in a lot of detail, don't worry, we will go into them in more detail when we get to the final accounts in Unit 3.4. Firms can choose to pay out their leftover profits as a dividend to shareholders, which you learned about in Unit 1, or choose to reinvest it back into the business, which is retained profit. This form of financing does not incur interest and does not dilute ownership, making it beneficial. The last one is sale of assets. This involves selling assets a business doesn't use. This typically involves selling non-current assets, such as equipment or real estate. Remember that these non-current assets are typically the long-term assets of the business. Selling assets can quickly generate cash without incurring debt. It also allows the business to streamline operations by disposing of unproductive assets. However, this source of finance relies on the firm having assets it doesn't use, and is therefore not a source of finance that the business can use frequently. As you probably noticed, internal sources of finance can be beneficial, but are also somewhat limited for firms, and therefore they also need to rely on external sources of finance, which are the funds that come from a third party. The first is share capital, which is the money raised by a company through the issuance of shares to investors. Remember that both privately held and publicly held firms can use this source of finance, but this is most common for public firms, as anyone from the general public can buy their shares via the stock market. This can allow the firm to raise a large amount of finance. However, it can also dilute ownership, reducing the control of existing shareholders. The second one is loan capital, which are the funds borrowed from financial institutions or lenders, which must be repaid over time with interest. Loan capital provides flexibility in terms of the repayment terms and the amount, which can be very beneficial to the business. However, interest payments can add up over time and can lead to reduced retained profits, as the firm must pay interest to the bank before paying out dividends to its shareholders. These are the two that come up the most in this course, and you will see how this applies when we look at the final accounts in Unit 3.4. Overdrafts are when a firm can withdraw more money than it has in its account, up to a specified limit. This provides the firm with short-term liquidity, allowing the firm to get additional flexibility in order to pay off an urgent bill. However, there's a very high interest rate associated with overdrafts, making them only appropriate for the short term, and not something that the business wants to rely on regularly. Trade credit is when suppliers allow businesses to purchase goods or services and pay for them later. This can allow the firm to better manage cash flow by delaying payments, allowing for access to inventory without the upfront costs. However, relying too heavily on trade credit can strain relationships with suppliers, particularly if payments are delayed. Crowdfunding is when a firm gets small contributions from a large number of people, typically via online platforms. You might think of GoFundMe as a very commonly known online platform. The firm typically gives up some shares in the business or gives investors something else that they want in exchange for this source of finance. This can help generate a large source of finance for the business, but also relies on the willingness of the investors to invest in the company, as these are typically regular individuals. Leasing is a financial arrangement where a business rents an asset instead of buying it. This allows them use of the asset without purchasing it, meaning there's a lower initial cost. However, in the longer term, leasing tends to be more expensive than buying the asset outright. Much like many people choose to rent a house or apartment rather than buying one, firms can also choose to rent equipment or office space rather than purchasing it outright in order to reduce their financial burden. Microfinance providers offer low-interest loans to individuals or small businesses that lack access to traditional banking services. This funding helps promote economic growth and empowers individuals who otherwise would not get access to financing for their businesses. However, it is also viewed by many as unethical, as it involves charging interest to lower-income individuals, even though this interest rate tends to be lower than the bank. Finally, business angels are wealthy individuals who provide capital to startups or small businesses in exchange for ownership. This not only provides funding, but also mentorship and access to the networks of the business angel. Bringing in business angels can dilute ownership, leading to potential conflicts in decision-making. Additionally, their involvement can result in pressure for rapid growth and profitability. For example, think of having Elon Musk or Mark Cuban invest in your company. There would be many benefits for you of having them as an investor, but you'd likely feel the additional pressure as they will expect extremely strong results and would likely also be somewhat involved in decision making. Finally, you need to consider when the various sources of finance are appropriate. Short-term sources of finance are those that are used for less than 1 year, while long-term sources of finance are those that are used for more than 1 year. Certain sources of finance, like trade credit, overdrafts, and leasing, are used for revenue expenditure and are therefore more appropriate in the short term and should not be suggested as longer-term sources of finance. By contrast, other sources of finance, like retained profit or loan capital, can be used for capital expenditure. Remember to consider the case context and why the business needs a source of finance when giving your response. That concludes the key concepts for this topic. We recommend you use these steps as part of your study routine. Pay particular attention to steps 2 and 3, as this is something overlooked by many BM students. Practicing case studies and developing application skills is the best way for you to improve your grade in BM, as all your school tests and the final exam are case study based. To practice these skills and access more detailed videos on BM content, please check out the resources on our website, diplomaly.org. If you need any support with any part of the BM course, including the IA or EE, feel free to get in touch with us via email or WhatsApp. Best of luck with your study.